I hope you're having a wonderful day, and I hope that you are doing well as everybody is trying to quarantine, self quarantine, social distance. Now, economically, we are looking at a whole lot of fear and change and uncertainty that is really affecting the stock market. And beyond that, the entire economy is affected. There's a huge loss of employment. People are not spending, they're conserving, and all of that uncertainty really plays a dangerous part in the economy because it causes people to just sort of we've seen food and other household items being hoarded, but people also want to hoard and save their cash, their savings. They don't want to spend, and whenever there's uncertainty, people are just afraid. And so you're going to see subscriptions to services canceled. You'll see people cutting any spending that they were thinking about doing on luxury items or nice to have items. Eating out, of course, is not a thing anymore. And so it's important to look and to be cautious about what kind of looks like a value investment in this environment, because there is a lot there are a lot of companies whose stock prices have come down so much, and now all of a sudden you might think, well, these things look interesting, they're very cheap, and you're comparing to value or valuations, I should say, on earnings going back a number of years. But that's not the case today. So there are companies that are not earning, they're earning next to nothing because their revenues are completely cut off with people not being able to go out. So I think a big factor now is just looking at the viability of a company. So airlines, for example, right now are in a very dangerous position. They're essentially at the mercy of what the government decides to do to assist them. And in their own business, they really have no control over whether or not they are going to be viable beyond this pandemic. If flights are not allowed to continue anytime soon, obviously for fear of spreading this disease so much more, rightfully so. So these businesses, it was almost unimaginable that you could take extremely large companies and think that they would be completely cut off from the vast majority of their revenue overnight. But here we are, and this is a reality. So I'm looking at a number of companies right now and thinking about how they are currently situated. And obviously it does have a lot to do with their past performance as well, and how have they been positioned historically within their respective marketplace. One example of this right now is Pfizer. So Pfizer, of course, a very large drug company, and has been, a major provider of a whole variety of different medications that people need for many years. This is not one that's going to be hit as hard by people who are constricting their spending. And so this is something that you might call recession proof. Some people might use that term, but I'm going to take a real quick scan of the numbers right now just to give it a preliminary analysis without diving much deeper into a lot of the other things that I think are very important. And with drug companies, you always want to look at, competition, competitive positioning. If there are patents, that's a big deal when it comes to companies like Pfizer. But overall, we know the portfolio is very strong. There are going to be big top selling drugs that you want to look at, but let's just give it a glance right now. So what I'm screening for these days is going to be companies that are profitable and have been profitable for a long time. So right away, we know that Pfizer has a strong return on equity, showing it to be above 26%. And I'll go to return on equity here. So return on equity is defined as, it's the calculation as net income attributable to common stockholders, net income minus the preferred dividends paid, so divided by its average total stockholders' equity over a certain period of time. Pfizer's annualized net income attributable to common stockholders for the quarter that ended December 2019 was minus $1.348 billion. So that gives us this calculation here, and the green that we see is a range over the past 10 years, and it is quite high. Its median is actually below 15, so just at 14.47. So something is going on that is boosting its return on equity that we need to look into a little deeper. So the other big thing that I'm really looking at these days is going to be the gross profit margin. So gross margin. And if we take a look at that, historically, it's been very high at Pfizer. So an extremely profitable company, probably a single source provider, of course, of many drugs that it sells. And so that means that profits are going to be quite high, and they appear to be stable at above 80%. And, basically trending flat for the most part. So a little bit higher back 10, 15 years ago, but trending still above 80%, which is extremely high. So very profitable. And that figure tells us that it has pricing power. So obviously there are antitrust factors to consider, but for a drug company to have a patent on a very important drug, for example, they are going to have pricing power, and they are going to be able to be profitable on that specific drug. So I think Pfizer here, of course, very profitable, high return on equities, and above all, stable. So a lot of these numbers are very regular. I'm going to just actually look at revenue. So revenue here, you can see the graph of revenue is very, very stable. So at least from, the late 90s up to today, its revenue not growing by a lot, actually not really growing over the past decade or so, but is very consistent. So, I mean, it will be important again to look at what future drugs they do have in their pipeline and what they do plan to sell in the future, or if any patents are expiring. But revenue is very stable, and so that's extremely important. So all of this is to say that Pfizer is a very good company. So overall, going back many years, it's profitable, it is stable, it is very strong and very well positioned within its marketplace. But Pfizer, like any other company, has to be valued. And even the best companies, you don't just buy at any price. Although some investors might think that depending on growth, then it's important to buy it at any cost. But in my opinion, a company even as good as Pfizer appears to be should be valued in a certain way and only purchased for a price that is appropriate. So what I have here is the interactive chart section under Guru Focus. So going back about 10 years at least, sometimes I like to look at 15 or more years historically. What is the median? What is the price at the median price to earnings ratio of this company? And does it follow it closely? Some companies don't really tend to follow it, especially companies that are evolving their product offerings in a big way over time. But essentially, what this gets down to is the Peter Lynch chart, where Peter Lynch and other investors would always use a guideline of a P of about 15. Historically, that's what the market has trended around or averaged around over time. And of course, there are big factors to consider, like interest rates and also bigger factors like profitability of the company and that sort of thing that may tend to bring up the average PE ratio of a specific company, just because investors in the market will value it higher and give it a higher valuation based on certain factors. So Pfizer seems to have that going for it. So at least for the past 10 years, its median PE has been about 24.1. So a little over 24. And obviously that's quite a bit higher than the market average around 15. So still, I find it valuable in that case to use the median PE because for a company like this, it's going to be pretty rare for it to dip below a price to earnings ratio of 15. And if it does, there's probably something bigger happening that we really need to know about. So it is today below its average historical PE ratio at 24. So which today would price it somewhere around $58.70 that we can see on this chart. And today's price being around $34. So it is cheap compared to its historic PE ratio. And if we look again back on the main page under Guru Focus, its PE ratio right now is just a little over 12. And of course, this is keeping in mind that this is based on earnings going back. So we do have to think about how its earnings are currently being affected by the global pandemic and the recession and all of these things. So a forward PE under 13 for a company like Pfizer appears to be extremely undervalued, or at least quite undervalued, depending on a number of factors. So that's my snapshot of Pfizer right now. There are a bunch of things that look really good about this investment right now. And there is a bunch of research that I still would need to do before deciding if this is the right company to invest in right now. Yes, there is uncertainty in the market, but that can be a good thing for an investor who's willing to do the research and figure out if something is a good long-term investment that makes sense, if something is a stable company that will be viable for many years and regain its place or retain its place in the market over a number of years, and if the price is appropriate in relation to where it is in its marketplace and what earnings it's able to bring in, then it's worth considering buying a company like this. So anyways, that's my snapshot of it. I hope you found it helpful. Let me know, and I hope you have an awesome day. Bye for now.